Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. And I have some exciting news for everyone today, because for the next few weeks, we're going to be doing something a little bit different with the show, putting a pause on the ongoing Becoming Buffett series we've been doing in the podcast, because on June 27th and 28th of 2017, just a few weeks from now, we're going to be having our mid-year DIY investing summit in partnership with Seeking Alpha. And it's going to be an exciting summit. We're going to have a lot of some of my favorite investors from Seeking Alpha are going to be a part of this summit, and we're going to have all kinds of topics, everything from what their favorite picks are, specific favorite investments are going forward from here, how they're shaping their portfolio for the second half of 2017, how they're hedging their portfolio in light of markets being at all-time highs, as well as how they go about identifying major trends and how do they identify companies to invest in, how do they research them, how do they make buy and sell decisions, all that stuff and more. So I hope you enjoy this preview of the DIY Investing Summit, and you can register for the summit for free at DIYinvestingsummit.com. That's DIYinvestingsummit.com for your free registration. Well, hey, Lawrence, welcome to the DIY Investing Summit.
Thanks, Brian. Good to be here.
We talked about hedging earlier on in the interview, but I want to ask one more question about that as far as your preferred way to hedge. I know obviously part of it will be how you shift your portfolio in terms of allocation to equities and cash and things like that. Right. But are there specific instruments you like to use for hedging, whether it be options or something else?
Well, yeah, I mean, it depends, everybody has different risk tolerances and different levels of sophistication in terms of the types of securities they use. But, if you, one way to hedge is, as I mentioned, own gold. I mean, it has a low correlation with equities. And so if, there's
you own
big
like
increase
physical
in volatility, gold? No. I only gold through the ETF, or okay. I own the gold miners. So, but if, and I want that liquidity to be able to move in and out, but, that's one way to hedge, is to own low correlated securities, of which gold would be. The other is just to keep a large cash balance, which is painful for most everyone, but because they're not earning anything, but you're not losing anything either, and it affords you the opportunity to act really quickly on opportunities when they present themselves. To be a little more aggressive, though, I use the inverse index funds. I don't like to hold. There's lots of levered products out there that you can buy where they're 2, 3, 4 times the volatility of the index, but you can't hold those for extended periods of time because they're going to dramatically underperform.
Right.
The way they're structured and the securities that they use within the portfolio to produce a 3 or 4 time daily return for an index leads to, if you just hold them indefinitely and the markets are flat, you'll end up being down 10%.
So tell me this, you said you don't like to hold them for very long. Does that mean like no longer than a month or a few weeks, or?
Well, yeah, I would say, even using like one of the ones I prefer is just the one-time inverse of the Russell 2000, because I think the small caps are going to continue to underperform the broad market or the S&P 500. RWM is the iShare inverse of the Russell 2000. So the Russell goes down 10%, RWM will go up 10%. And now, ideally, I don't want to hold that indefinitely. But if the market were to rally and become extended on a technical basis, I would add, I can add exposure to RWM. If there's a correction or the market pulls back 5%, perhaps I might take that hedge off and look to add it back on, if the market were to rally back up again. So I might hold it for several months. But it is if it's being used to simply hedge long exposure, you might hold on to it for a longer period of time. Like, for example, If I held RWM and I was hedging my exposure to Apple, I could hold RWM and hold Apple, and Apple's going up 40%, RWM is down 3%. Okay, that's fine. That's a hedge that worked. But if it's unhedged, if you're not hedging it, if you're speculating with these, then you're purely looking at it from a trading standpoint. If an indice breaks out to a new all-time high, you need to take the loss and reevaluate.
You said, I'm sorry, go ahead.
No, I think that's the way that you want to use these. It depends on whether you're using them to truly hedge long positions or you're using them to speculate on the downside.
Right. No, that makes sense.
And lastly, the other things, I use options quite a bit, and I will use. I focus on two things. I focus either on selling call options on existing stocks that I own, which where I'm basically committing to selling the stock at a higher price than it is today at some point in the future, and in return, I'm being paid a premium, much like a dividend from the company. And if the stock falls or stays at a current level, then I get to keep that premium. And upon expiration, I can do it all over again. So I can hedge. In fact, I recently sold covered calls on Qualcomm at 60 for a June expiration. So, I think the stock will have difficulty getting through that price level. So it pulls back down. Let's say it's back down to 57, 56 in June. My call will expire. It may even be down in the low 50s where I might buy more of the stock. But that's just a way to monetize a position that, but you have to be willing to sell the stock at the price you're
right.
At your strike price, your price you're willing to sell the call. So, and then lastly, I'll use option spreads on indices where I can buy let's say I'm going back to the inverse fund for the Russell 2000 RWM. I might buy a call option on RWM at let's say at a strike price that's slightly in the money or below where the RWM is currently trading, and then sell a higher strike price to reduce the amount of money that I'm spending and potentially losing.
A higher strike price call option.
Yeah, and that's called a spread. So I'm buying a lower priced strike and I'm selling a higher priced strike in the same month, and that's the spread. And so my maximum gain is the spread. So if I were, buying a call on RWM at 45 and selling a call at 55, that's a $10 spread. If I paid $5 for the call that I bought and I received $2 for the call I sold, my net cost would be $3. And so my potential gain would be $7 on that $10 spread. But the most I could lose would be $3. So that's another strategy that you can use to hedge a decline in the broad market over a certain period of time, where it's like buying an insurance policy. Essentially, I know what the payout's going to be, and I know what my premium is going to be that I'm going to spend. So whether you go out a month or 6 months or 12 months, that can vary as well. But that's another strategy that I'll use with options to hedge a portfolio.
So you said time frames you could do anywhere 1 to 3 months, just depending on the dynamics.
Well, the more time you buy, the more it's going to cost, and so the idea behind going out longer term, obviously, it may cost a little more, but you've got more insurance for that time period. So if I go out to January of 2018 to put on a spread on the Russell 2000, ideally, if I buy a call that's in the money, there's gonna be some value there at the end of the year if the market doesn't go anywhere, if it's flat. But I'm going to reap all the gain from the higher strike call option that I sold expiring worthless. So it's a little bit lower risk than going way out of the money and speculating that something huge is going to happen. But I've used those both short term to speculate, and right now, as an example, I have a spread for July that is, and that's actually a spread on one of the levered products, so it's extremely aggressive. But it's a very short term speculative trade that I'm looking for. I'm looking for a pullback in the broad market, and in particular the Russell 2000 over the course of June. It's not the kind of thing that everybody's going to want to do.
Yeah,
So,
yeah, no, but
depends on the investor,
Yeah, but it's just fun hearing how different people do hedge and different options that are available. One thing you mentioned earlier, a quick follow-up, you said one way to hedge is keeping a large cash balance. What percentage-wise would you consider to be large?
Well, I think again, it depends on. I think that depends on the type of investor. Like, for example, if you're a trader, it might be extreme. It might be 60-70% of your portfolio. If you're a really long-term investor and you're a little more conservative, it might actually be lower because your exposure to fixed income and more stable investments is going to be higher. So, most of the cash that I have on hand in a portfolio is coming from reducing exposure to the higher risk asset classes like equities. So I'd say, for sort of your moderate risk type long-term portfolio, maybe a high cash position might be 30-35%.
Well, I hope you enjoyed this brief interview preview from the DIY Investing Summit. And if you enjoyed anything about this and found any value in it, I assure you will thoroughly enjoy the full interview. And you can register for free at DIYinvestingsummit.com. That's DIYinvestingsummit.com. And free registration, and then the summit goes live on June 27th. And so look forward to seeing you there. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.